Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. Welcome back. I'm glad to be back here this week to show you guys what I'm currently looking at as far as my charts and research go. So let's go ahead and get started. Before I do, just a quick disclaimer, what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that trade options here at Firstrade, I just want to remind everyone again that the new iOS and Android platform is a fantastic new platform with new features to help you manage and trade your complex orders. So for those of you that trade options, I highly recommend you to take a look at the new iOS and Android platform. So we're going to go over a few things here today, but we're always going to start with the broader market update as far as where the major indices are trading. Many of them are now trading at new all-time highs. And I want to talk about specifically about how we've seen that the market health has declined as these equity markets reach new all-time highs. And predominantly what we're going to do is look at the evidence that we're currently seeing that shows why the market health has currently declined and what impact that has so far, predominantly in rates. Rates have picked up, and we want to take a look at where they've picked up and how this is influencing the market and where there are potential opportunities from rates rising higher here. We're going to take a look at some of the economic data to give us a better sense for the shape of the recovery, the speed of the recovery, which has started to slow down a little bit, and then share with you some of our ideas. And if we have a few minutes at the end, we'll open this up for Q&A. So those are the things we're going to go over. But the primary question that I want to help investors answer, which is something that predominantly we have heard over and over again for the past few months, I would say, is really, are we watching the final innings of a market top? We've been getting questions pretty much since June as to whether the market has topped and whether we should be buying puts and looking for a market correction. And we've consistently remained on the sidelines saying that the market health has been fairly healthy, that it's not, we don't see imminent signs of a market pullback or a market breakdown just yet. We continue to see signs of exhaustion. We continue to see signs of market health declining over the past few weeks, which certainly adds to the risk of continuing to look for long positions, but we still haven't seen any evidence just yet of an actual pullback. So what I want to do is I want to frame today's session in the light of, yes, we see risks. Yes, we see a lot of health of the market declining. We see a lot of signs of exhaustion, but it's not quite yet ready to pull the trigger on that short just yet. Now, that can happen tomorrow, that can happen next week, or that can happen next month. We don't know how long this can go on for. That's the challenge with trading these types of markets. So I want to make sure investors are familiar with what I'm trying to say. So my name is Tony Zhang. I'm the chief strategist here at Options Play. And today what I'm going to do is I'm going to share with you my charts, my economic research, and how I'm currently looking at the markets. So we'll start off with the S&P 500. So while I was out last week, we opened up now at a new all-time high earlier this week. And what we're starting to see is the negative divergence that we saw here in the NASDAQ 100 index. However, money flow remains extremely strong here. So this leads us to believe that this market can continue to push higher despite this negative divergence. And again, negative divergence is something that can last for a long time before it resolves itself. And for the most part on the daily chart, the momentum has confirmed this recent move higher. So we believe that at least here on the S&P 500, it can continue to move higher here for some period of time before we see an actual catalyst of a breakdown. But again, we see signs of exhaustion. One of the places that we're looking at is the number of stocks above its 50-day moving average. And we're seeing negative divergence because as markets move to new all-time highs, we've seen a decline in the number of stocks that are trading above its 50-day moving average. This is showing us that the health of this market rally is getting weaker. So over the past few months, we have said that the health of the market has been fairly strong. And we've consistently shown you how the small caps, equal weight indices have been keeping largely up with the market cap indices. Those are the signs of the healthy market. We also talked about sector rotation. We're not quite seeing as much of that sector rotation right now. We're certainly seeing some of these indices fall behind. But the NASDAQ 100 index continues to march higher. despite this negative divergence. So we talked about this negative divergence when it first broke out above that all-time high from February. But what we're not seeing right now is this negative divergence resolve itself. So we're continuing to see this stretch negative divergence, which is something that we're talking about here on the S&P 500. We're just starting to see the signs of it. But as you can see, the markets can move substantially longer with this negative divergence for long periods of time. We're seeing this on the weekly chart and on the daily chart, where as the markets continue to move higher, momentum does not confirm those moves higher. We saw this during November to February of 2019 to 2020 as well. But again, just because you see divergence in itself is not a signal to go short. Now, if we look at even a closer segment of the market than the FANG index, this is an equal weight 10 stock index. And what you see is this continued negative divergence as the FANG index continues to make new highs. The momentum indicators do not confirm these new highs, and they're reaching fairly overbought territory. So if we look at the concentration in these 10 stocks, these 10 stocks now account for a very, very large percentage of the S&P 500. The concern here is not just the concentration, but the fact that the concentration is now in a single sector. If we look historically, we've seen periods of time where the top 5 or top 10 stocks dominate the market cap of the S&P 500. But historically, what we've seen is that that's been across multiple sectors, meaning the top 5 stocks are across 4 or 5 different sectors. Now we're seeing these top 5 or 10 stocks all in a single sector. That adds to the risk that we currently see here in this concentration that we're seeing. And we're starting to see this concentration increase its narrow leadership, because if we look at the small caps for the most part kept up with the rally from March to June. Ever since that, it has now fallen behind. It had periods of catch-ups, but again, as equity markets like between the S&P 500 and the NASDAQ 100 makes new all-time highs, the small caps indices have actually continued to decline. So we're seeing this correlation between small caps and mega cap names start to decline. These are further signs that the health of the market rally is declining. We're seeing the same thing across equal weight. The equal weight S&P 500 index over the past few weeks has again continued to fall behind. It's catching up a little bit yesterday, but that hardly is enough to keep up with the health of this market rally. So we're continuing to see signs of this decline in the market health. Now, if we look at the VIX 3M versus the front month VIX, so this is the 3-month VIX versus the front month VIX, this ratio, when it's above 1.25%, we generally consider this a fairly complacent reading. So when we have this type of complacent readings, these are signs that there is a potential reversal on the horizon. And it's, again, these are contrarian indicators. What that means is that they give you a higher probability of a pullback, but it doesn't mean that you're going to get a pullback. So be careful. What you want to see is an acceleration to the downside. That's actually the signal that you get to short the markets. Just because markets are complacent does not, generally speaking, mean that it's a good time to short the markets. But I think the big thing to really pay attention to here right now is the breakdown that we've recently saw in rates. So we've seen bonds sell off here last week. It's rallied a little bit over here over the past couple of trading periods, but I actually think that you might get an extension here to the downside. And we have to take a look at the rates market to get a better sense. So TLT, the 20-year Treasury ETF, starting to see a decline here after that double top posted here in this 170, 171 range. But what you have to look at also is the TIPS, the inflation, Treasury inflation ETF. That has not seen that same decline. So certainly inflation expectations here still driving this market. But as you can see, we're seeing rates start to pick up here. So what I noticed here last week was that we've seen that rate pick up here on the 10-year yield. The rate went from about 50 basis points to about 70 basis points. On a relative term, that's a big, sizable move. And what we had subsequently is a decline back to the 20-day moving average. And yesterday, the rates started to move higher again. So long-term on the weekly chart here, generally speaking, we've seen the 20-week moving average provide resistance. But here's the first sign of evidence where you've got a pickup and then usually it went straight down below the 20-day moving average. Here we've gotten above the 20-day moving average, came to see this as support, and now might actually start to move higher here. So as rates move higher, this is something that we need to pay attention to. And we're seeing this somewhat across the curve here. So we saw the move here in 2-year rates as well, came back to test the 20-day moving average, and is now starting to move higher here. So this gives us some evidence that perhaps we could start seeing some pickups here in financials, which is extremely rate sensitive. So we're going to take a look at some of the financial names here for today as a potential idea. But the rates market telling us something. So when we're thinking about, is there a reversal in equities coming? Many times the rates markets may give us some clues first, and we're starting to see some movement here in the rates market that could potentially generate that potential sell-off here in equities. Now, we're talking about the dollar index. We've been talking about this for a while because of the breakdown below 96. This is what's driven a lot of the gains here in gold over the past few weeks. But as you can see, the dollar index not really moving much lower here over the past couple of weeks. It looked like it was consolidating for a little bit of time and then started to break down again. It was going to move substantially lower, but it didn't. It actually just went straight back into the consolidation range. So I would say that it's still probably in that consolidation range here. Now, the question here is whether it's going to move back higher or move back lower. We don't quite know yet, but that's one of the things that we're paying attention to. Now, with rates moving higher, that generally leads us to believe that there's a higher probability that dollar index actually moves higher. So when you put all these things in place, when we look at gold and silver, you have these two things here at play. You have dollar now potentially strengthening, which is weak for gold, but then you have inflation expectations now becoming more and more of a topic, which generally speaking, gold is used as a hedge for inflation. And that's kind of why we've seen this kind of flip-flop here between gold and silver in this trading range over the past couple of weeks, because as investors are looking at these two possible, I would say, headwinds for gold, and that's why we're not seeing such a big move here in gold. And the question is, which side is going to win? We don't know quite yet. So at this point, I think for gold and silver, it's more, from my opinion, is more on the sidelines rather than looking for a big move here in gold and silver. Now, emerging markets has broken out above this $44 range. So we've been talking about this $44 range for a while. It broke out, but couldn't really make any big moves. It looks like it might be starting to move a little higher here, so pay attention here to EEM. What looked like it was going to be like a head and shoulders formation, that's still possible that you get a pullback here, but I'm looking for potentially a breakout here for EEM. So paying attention to here to emerging markets. So with that, I wanted to share with you some of the economic research. So first of all, when we talk about a V-shaped recovery, that V-shaped recovery is looking more and more like what could be, maybe a W-shaped recovery, because we're already starting to see a slowdown in some of the economic indicators. If we look at the Bloomberg Economic Expectations Index, we're starting to see this starting to move lower here. We're seeing consumer confidence also move lower. This is a key indicator for me, is consumer confidence, because prior to the coronavirus, 70% of US GDP has been consumer driven. So this is a massive driver of our economy. And when you see consumer confidence move lower or tick lower, or at least flatlining for the most part, that is a concern that I see for this current market rally, or for the recovery that we're currently seeing, or what the shape of this recovery. So this is the economic data that we've been looking for to get a better sense for the shape of the recovery. And we're starting to see some data showing that the recovery is certainly slowing down and is not moving ahead at the same pace it did back in May and in June. If we look at the U.S. recovery tracker, we did see a small uptick here over the last week here. Now, this uptick actually has been the biggest uptick we've seen for about 8 weeks now. So we are seeing recovery, but I think the big trend here is still that over the past 8 weeks or so, we've seen very little on the recovery side. So this is, as you can see, the pace at which we were recovering between late April and early June was significantly faster than what we've seen over the past 8 or 9 weeks. And if we look at the Philly Fed Manufacturing Index, we've also seen back-to-back declines in terms of the growth here, even though the actuals came in a little bit lower than the consensus here for these types of economic indicators. So The recovery certainly in place, the recovery certainly there, however, not at a particularly fast pace and certainly slowing down the pace at which we are recovering. So those are some of the concerns that we see in the overall market. So with that, what I wanted to do is share with you some of my ideas. First of all, as far as rates, we've seen the 10-year rate, we've seen the 2-year rate across the curve pick up. This rate expectation, this pickup in rates, generally speaking, is supportive of financials. Financials still, to this day, the second worst performing sector in the S&P 500. At this point, when you're trading at all-time highs, at stretch valuations, and you see this negative divergence, and you see the concerns with the market, I don't particularly love chasing these new all-time highs. Growth stocks that are continuing to trade to very, very stretched valuations. I much prefer trying to see where we see rotation here in the sectors. And XLF certainly the financials, one of the sectors that we're seeing some rotation out of some other sectors like utilities and healthcare. And that's where I'm looking for a potential breakout here on a strong stock like Morgan Stanley. There are quite a few names here in this particular camp. If you look at Goldman Sachs, JPM, Morgan Stanley, I happen to like Morgan Stanley the best out of those. We do have a nice triangle formation. It looks like we might be able to break out here to the upside. So Morgan Stanley is one that I'm paying attention to above $53. If it can get back above 53, I think you have the resumption here back into this 57, 58 level here that was put in back here in the February highs here in that $57, $58 range. So Morgan Stanley, potential breakout opportunity that is supported by the current pickup that we're seeing in U.S. Treasury rates. The other one I want to take a look at is Comcast. Comcast, from a chart perspective, looking fairly similar to Morgan Stanley, finally breaking out above this $43 level that was put in back here in early June. Tried to break out once but failed, and is now coming back here to potentially make another crack at this breakout here. So your upside here is to the $47, $48 area. Comcast, the reason that I like the stock from a fundamentals perspective, because you really have both a broadband and streaming play. As for those of you that have watched me on CNBC last Friday, I spoke about a specific statistic that I thought was very interesting. The Bank of America survey that they recently did saw that about 45% of all employees are now working majority of their time from home versus just 5% previous to COVID-19. So that's a 900% increase in the number of employees working from home. So broadband needs are going to substantially increase, and you have Comcast streaming. So you have really the confluences of two fairly strong fundamental factors in this post-COVID-19 world that I like about Comcast. So fundamentally and from a technical perspective, I quite like this particular chart. If we look at Delta, I did want to look at travel stocks as well, because travel stocks, hasn't been in the headlines very much, but we saw about a 10% move on most of the airlines yesterday. I just want to warn investors that, beware of this recent uptick we've seen in some of these travel stocks, especially the airlines, simply because there's not a lot of evidence that travel has picked up substantially. Certainly not the corporate side. The corporate travel is almost still completely non-existent. We have some pickup in leisure travel, but that is predominantly more so, I would say, effective of the discount airlines, the ones that service leisure travelers like Southwest, Allegiant, Spirit, those types of airlines. Delta Airlines predominantly serving the corporate travelers. I'm concerned about these types of 10% moves. I actually think that there are potentially better selling opportunities rather than buying opportunities. So those are some of the names that I would be careful of in terms of this rally, unless it can really break out here to the upside. But I don't see a lot of evidence of a pickup or a reversal here in some of these travel names. Certainly not necessarily justifying a 10% move in a single day. Another sector that I'm paying attention to is healthcare, because healthcare has continued to decline and fall behind on the recovery and the S&P 500 moving ahead. So some of the names that I see some weakness here are names like some of the insurance companies like Cigna. As you can see, as the markets continue to move higher, Cigna and some of the insurance companies are moving lower. So not only is it moving lower on an absolute term, it's moving substantially lower on a relative basis. So it's severely underperforming the market. These are not the types of names that you want to hold. And it's now breaking below what I would consider some significant support levels in this 180 area, which has been a solid support pretty much since the recovery, but it's now starting to break below that. So my concerns is that you could see some potential moves lower. Now, in this particular type of market, I think shorting the market is difficult to do, meaning buying puts, I think it's difficult to do. I think the best case for these types of trades is selling call and credit spreads is a much better way to play these types of names that I'm starting to see some weakness in that would potentially roll over if markets just trade sideways or start to move lower a little. These are the names that are likely to see some significant moves to the downside. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to how we're framing this market and helping you answer that question regarding, how do you continue to invest in this type of market where the economic and fundamental backdrop is so far disconnected from where equity markets are trading, what you should be paying attention to, help you signal when you should consider perhaps looking at some shorts, where do you look for some shorts, and in the meantime, where do you still see some opportunities here to the upside. So with that, I have a few minutes to try to answer a few questions. If anyone has some, you can type them into either the chat window or the Q&A window, and I'll try to answer your questions here before. Hello, Tony. How do you see Tesla before the split? So this is actually something we covered on CNBC on Friday. So one of the things is that one of the chart patterns that we've seen is that you've had a $700 move here to the upside from that 950 level. And then what you had is a bit of a consolidation range, or what we call either a flag or a pendant. And then you had another $700 move. So I see this as a temporary top here around 2050, which is why I suggested selling a 2100, 2150 call spread. And basically it profits as long as Tesla stays below that particular range over the next month or so. So that's my view here on Tesla short term. Again, one of the things that we talked about is that stock splits have no fundamental change on the company. Just because it splits doesn't mean there's nothing about the company fundamentally changes. You just get more shares at a lower price. That's it. The market seems to take it differently. Markets rallied 35% from the announcement. So I think that markets went a little too far, too fast on that split news. The average move on a split is usually about 3%. Amazon has done tenfold that. So I think a little too far, too fast here on Tesla. Roger's asking, PFE will be out of the Dow. Does this mean stock prices will move down? So, there certainly is going to be some rebalancing, meaning as ETFs and mutual funds that hold PFE in their Dow funds will have to sell these positions. So you might see some selling pressure here, but generally speaking, they don't provide any significant moves to the downside. You're not going to see a significant move, in my opinion, on names like this. Energy. So energy, crude, there are a couple of factors here. I don't like crude at all, because of the fact that despite dollar weakening, we have not seen crude move higher. But we do have some, we have two hurricanes about to hit the Gulf. That is some, there is some potential that refiners in that area will get hit. There's going to be a potential higher price here in crude as a result of that, but I do think that that's going to be short term. I don't like the energy names. My preference is to be more on the short side rather than the long side, but there are some short term, I would say, news driven events that could move energy or crude. What does divergence mean? Divergence just means where you have, normally what you like to see is as markets move higher, you see the confirmation confirm that move higher. When you see markets move higher, but the momentum does not confirm those moves higher, that's a sign of divergence. Divergence tells you that not everything is okay. Things are looking like that it might be a bit of a house of cards. That's kind of what divergence means. What about Amazon? I mean, Amazon continues to dominate. I mean, there's no doubt about this. I do have some concerns as far as how far these stocks can continue to move. Again, sort of signs of divergence as you get higher highs, momentum not confirming those highs. So I do think that you could have a higher probability of a pullback here in Amazon. I don't think you're going to get a massive pullback here, but I think a pullback below the 20-day moving average into the 3,100 range is possibly on the cards here for Amazon. What about EWZ? So EWZ, you know, Brazil economics, the economics of economic indicators coming out of Brazil have been actually particularly strong. So while equity markets are fairly weak here, I see this as a potential opportunity to potentially go long because we have had the sideways market here for quite some time, and you are trading near the bottom of that range. So just from a statistics and probability perspective, I would prefer to be more on the long side, especially as we're seeing some of the employment and economic indicators come out of Brazil to be fairly strong. Future outlook on GLD, like I said, I think GLD is going to be more likely sideways as we've seen here. We could get a breakout here, especially as inflation concerns continue to come back. But as of right now, I think with the dollar index, you know, with rates picking up, that's going to put a huge downside pressure here for gold. So I'd be paying attention here to this 180 level. If we break below 180, I think that's game over for gold for the short term for now. What does GDX look short term? Same thing as gold. You know, the line in the sand here for GDX is probably the $40 range. If we fall below 40, I think that is game over here for GDX. And I think this is all a rates play. Rates moving higher is bad for gold. You know, you have some inflation concerns. That's one of the few parts of the rates market that is actually holding up. So you have these two factors at play, but I think rates are going to have a larger effect here than inflation. Apple will go higher after it's split. Well, I mean, the fundamentals of Apple looks very strong here, but it does look a little too far too fast. Boeing. Boeing is another one of these names similar to the airlines that I would be very careful of. You know, every single time it touches a 20-week moving average, that's more of a sell signal. So you have these opportunities to potentially go short these markets. That's how I'm currently looking at Boeing. Now, if it can break out above this trend line and break out, then I would be more interested in this. But at the moment, I don't see a strong move here in Boeing. Gold, same thing as silver. So with that, that covers what I wanted to share with you here today. I hope that this was useful in helping you guys frame your trading day and understanding where to currently look at from a macro perspective. So with that, thank you so much. I hope that you guys have a great trading day, and I'll see you guys here next week.